I've summed up my 5 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Please share with me your opinion about this book in the comments below. Asset Allocation by Roger Gibson is a comprehensive guidebook that provides a complete overview of the process of building and maintaining a diversified investment portfolio. The book covers a wide range of topics related to asset allocation, including the principles of diversification, the role of asset classes, risk management strategies, and the importance of rebalancing. One of the key takeaways from the book is the importance of diversification in investment portfolios. Gibson emphasizes that investing in a mix of asset classes, such as stocks, bonds, real estate, and commodities, can help reduce risk and improve returns over the long term. The book provides a thorough analysis of each asset class, explaining the characteristics, risks, and benefits associated with each. Another important theme in the book is risk management. Gibson stresses the importance of managing risk by selecting a mix of assets with varying levels of risk and return potential. He also recommends using various risk management tools, such as stop-loss orders and trailing stops, to help limit losses and protect gains. Throughout the book, Gibson emphasizes the importance of maintaining a disciplined approach to asset allocation. He recommends establishing clear investment goals, developing a long-term strategy, and regularly monitoring and rebalancing the portfolio to ensure it stays aligned with the investor's objectives. One of the strengths of the book is its practical approach to asset allocation. Gibson provides a wealth of real-world examples and case studies to illustrate the concepts and strategies discussed in the book. This makes the book accessible to investors of all levels, from novice to experienced. Overall, Asset Allocation by Roger Gibson is an excellent resource for anyone looking to build and maintain a diversified investment portfolio. The book provides a comprehensive overview of the principles of asset allocation, risk management, and portfolio rebalancing, and offers practical advice for investors looking to achieve their investment goals. Diversification is a fundamental concept in investing, and it refers to spreading out investments across multiple asset classes to reduce risk and increase potential returns. In the book Asset Allocation, Roger Gibson explains that diversification helps to protect against market volatility, as different asset classes tend to perform differently under varying market conditions. For instance, stocks may perform well during an economic boom, while bonds may perform better during a recession. By investing in a mix of asset classes, investors can benefit from the strengths of each class while minimizing their weaknesses. This means that a well-diversified portfolio is less likely to experience significant losses when one asset class is underperforming. In contrast, a portfolio that is heavily weighted in one asset class can be more vulnerable to market fluctuations. Diversification can also help investors achieve a more stable rate of return over the long term. While certain asset classes may experience high returns in the short term, these gains can be offset by losses in other classes. Therefore, diversification can help investors achieve a more consistent return on their investment over time. Overall, diversification is an essential part of successful asset allocation. By investing in a mix of asset classes, investors can reduce their exposure to risk while increasing their potential for long-term returns. Risk management is an important component of successful asset allocation. In the book Asset Allocation, Roger Gibson stresses the need for investors to manage risk by selecting a mix of assets with varying levels of risk and return potential. This means investing in a range of assets, such as stocks, bonds, real estate, and commodities, to create a diversified portfolio. One common risk management tool is stop-loss orders. A stop-loss order is an instruction to sell a security when it reaches a certain price point. This can help limit losses in the event of a market downturn or unexpected event. For example, if an investor sets a stop-loss order for a stock at 10% below its purchase price, the stock will automatically be sold if it drops by 10% or more. Another useful tool is trailing stops. Trailing stops are similar to stop-loss orders, but are designed to follow the market price of a security. As the market price of the security increases, the trailing stop will automatically adjust upward, ensuring that the investor can capture gains while still protecting against losses. Gibson also emphasizes the importance of regularly reviewing and rebalancing a portfolio to manage risk. This involves assessing the performance of each asset class and adjusting the portfolio to ensure that it remains aligned with the investor's goals and risk tolerance. For example, if stocks have outperformed other asset classes, an investor may need to sell some of their stock holdings and reinvest the proceeds in other asset classes to maintain a diversified portfolio. In summary, risk management is a crucial part of asset allocation. By investing in a mix of assets, using stop-loss orders and trailing stops, and regularly reviewing and rebalancing a portfolio, investors can effectively manage risk and protect their investments. In the book Asset Allocation, Roger Gibson stresses the importance of having a disciplined approach to asset allocation. This involves setting clear investment goals, developing a long-term strategy, and regularly monitoring and rebalancing one's portfolio to stay aligned with those goals. The first step is to establish clear investment goals. This involves defining one's investment objectives, such as maximizing long-term growth, generating income, or preserving capital. By establishing clear goals, investors can better align their investment strategy with their overall financial plan. Next, investors should develop a long-term strategy that takes into account their goals, risk tolerance, and investment time horizon. This involves selecting a mix of assets that are consistent with one's investment objectives and risk tolerance. For example, a young investor with a long time horizon may choose to invest in more volatile assets, such as stocks, while an older investor with a shorter time horizon may focus more on income-generating assets such as bonds. Once an investment strategy has been established, it is important to regularly monitor and rebalance one's portfolio to ensure that it remains aligned with one's goals and risk tolerance. This involves periodically reviewing the performance of each asset class and adjusting the portfolio to maintain the desired asset allocation. By taking a disciplined approach to asset allocation, investors can reduce the impact of market volatility on their portfolios and increase the likelihood of achieving their investment goals. Gibson emphasizes that investors should remain focused on their long-term objectives and avoid making impulsive investment decisions based on short-term market fluctuations. Overall, a disciplined approach to asset allocation involves establishing clear investment goals, developing a long-term strategy, and regularly monitoring and adjusting one's portfolio to ensure that it remains aligned with those goals. Costs and fees associated with investing can have a significant impact on investment returns. In asset allocation, Roger Gibson emphasizes the importance of minimizing costs to maximize investment returns over the long term. One way to minimize costs is to invest in low-cost index funds or exchange-traded funds, ETFs, rather than actively managed mutual funds. Index funds and ETFs are designed to track the performance of a specific market index, such as the S&P 500, and typically have lower management fees and expenses than actively managed funds. By investing in low-cost funds, investors can reduce the impact of fees on their investment returns. Another way to minimize costs is to be mindful of transaction costs, such as brokerage fees, commissions, and taxes. These costs can add up quickly and erode investment returns over time. To minimize transaction costs, investors should consider investing for the long term and avoiding frequent trading. Additionally, investors can benefit from tax-efficient investing strategies, such as holding investments in tax-advantaged accounts like IRAs or 401(k)s. Finally, investors should be aware of the impact of inflation on their investments. Inflation can erode the purchasing power of investment returns over time, so it is important to consider the effects of inflation when selecting investments. For example, inflation-protected securities, such as Treasury inflation-protected securities, TIPS, can help protect against the negative effects of inflation. In summary, minimizing costs is a crucial part of successful asset allocation. By investing in low-cost funds, being mindful of transaction costs, and considering the impact of inflation on investment returns, investors can maximize their investment returns over the long term. In Asset Allocation, Roger Gibson highlights the importance of diversification as a key element of successful asset allocation. Diversification involves spreading investments across multiple asset classes, sectors, and geographies to reduce overall portfolio risk and increase the likelihood of achieving long-term investment goals. One of the benefits of diversification is that it can help reduce the impact of market volatility on an investment portfolio. By spreading investments across multiple asset classes, investors can reduce their exposure to the ups and downs of any one particular market or sector. For example, if one sector of the economy experiences a downturn, investments in other sectors may help offset those losses. Another benefit of diversification is that it can increase the potential for long-term returns. By investing in a variety of asset classes, investors can capture returns from different sources and increase the likelihood of achieving long-term investment goals. For example, investing in stocks, bonds, and real estate can provide exposure to different types of returns and help reduce overall portfolio risk. It's also important to diversify across geographies, as different countries and regions may perform differently depending on economic conditions, political stability, and other factors. By investing in international markets, investors can increase the diversification of their portfolios and capture returns from different parts of the world. Gibson emphasizes that diversification does not guarantee profits or protect against losses, but it is an important tool for managing risk and increasing the likelihood of achieving long-term investment goals. It's important for investors to regularly review and rebalance their portfolios to ensure that they remain diversified and aligned with their investment objectives and risk tolerance. In summary, diversification is a key element of successful asset allocation. By spreading investments across multiple asset classes, sectors, and geographies, investors can reduce portfolio risk, capture returns from different sources, and increase the likelihood of achieving long-term investment goals. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.